Have you ever paused to consider what truly fuels a nation?
Mm-hmm.
We're talking about those, colossal public sector undertakings,
Mm.
the real backbone of a country's energy.
Absolutely. Giants, really.
Exactly. And today, we're embarking on a deep dive into one of India's most significant players, Coal India Limited, CIL.
A household name in the energy sector there.
For sure. Our mission today is to crack open their recent Q1 FY26 financial results.
Right. That's the first quarter ending June 30, 2025.
Yep. And this isn't just about, rattling off numbers. It's about unearthing the story behind them.
Getting the context.
Precisely. We've sifted through their official financial statements, the auditor reports, corporate presentations, all of it,
The primary sources.
to distill the most important nuggets of knowledge just for you. So let's jump right in.
Let's do it. Where do we start? The top line.
Yeah, let's start with CIL's financial health. How do they stack up in Q1 FY26 compared to the same quarter last year, Q1 FY25?
The big picture first.
The headline figures, well, they show a noticeable cooling. Overall revenue from operations dipped 4%,
Okay, 4% down.
settling at around 35,800 crore versus 37,500 crore last year. Net sales followed suit, also down 4%.
Similar trend there.
But here's where the picture gets sharper. Profit before tax, PBT. That took a more significant hit,
Ah, okay. How much?
dropped 17%. From over 14,000 crore down to about 11,700 crore.
17%. Wow, that's quite a drop compared to the revenue dip.
It is, and profit after tax, the PAT, saw an even steeper decline, down 20%, landing at roughly 8,700 crore.
20% on the bottom line. Okay. That sharp profit decline is what really jumps out, isn't it?
Definitely.
Because while the revenue dip is, well, relatively modest for a company of CIL's massive scale.
Right, 4% isn't catastrophic on the top line.
Exactly. But that significant drop in profitability, 17% PBT, 20% PBT, it tells us there's more at play than just a slight reduction in sales. It immediately raises the question, what exactly is squeezing their margins so intensely? It's clearly not just a straightforward top-line issue.
Absolutely. So the initial numbers hint at a squeeze, like you said.
Mm-hmm.
But to truly understand why CIL's profits took this hit, we need to move beyond just the financials
Got to look at the operations.
and unpack the very core of their business. How much coal did they actually, produce and sell this quarter?
The physical volumes.
Let's look at those operational realities. Coal production volumes for Q1 FY26 came in at 183.32 million tons, MT.
Okay.
That's a 3% decrease from the previous year.
So slightly less coal dug out.
Right. And coal offtake, which represents the total coal sold and dispatched, that also saw a dip, down 4% to 191.04 MT.
So less produced and less sold or shipped out.
Exactly. And even overburden removal, OB removal, that's the earth they need to move to get to the coal.
It's the key preparatory step.
That was down 5% as well, to about 508 million cubic meters.
Okay, so stepping back, what this consistent dip across production, offtake, and overburden removal tells us is, well, it suggests a clear, if slight, deceleration.
A slowdown.
Yeah, a slowdown in CIL's operational rhythm this past quarter. It points to a consistent easing across their fundamental activities. Not dramatic, but noticeable.
Okay. Given that slowdown, where's their inventory stacking up? Let's look at the raw coal inventory figures.
Always a critical number.
Their closing stock as of June 30, 2025. It stood at 98.94 MT, almost 99 million tons.
Right. How does that compare?
Well, interestingly, that's actually an 8% reduction compared to the end of the previous quarter, March 34, 2025.
Okay, so they cleared some stock in Q1.
They did. However, and this is the key part, it's a significant 24% increase compared to June 30, 2024, a year ago.
Ah, okay. That's the interesting part. That contradictory inventory trend is crucial.
How so?
Well, while they've managed a short-term stock clear out quarter on quarter, which is good, that significant year-on-year buildup, 24% higher than last year. That points to potentially a deeper unresolved challenge.
Like what? Weaker demand?
Perhaps weaker long-term demand, or maybe persistent logistical hurdles in moving the coal. Either way, it's a key indicator of potential capital being locked up if that stock isn't moving efficiently over the longer term.
Got it. So we've seen the profit dip, the operational slowdown, and this kind of mixed inventory picture.
Yeah.
What does this all mean for their net sales, which, as we said, we're down 4% overall? Let's break down the key drivers of that revenue shift.
Yeah, let's unpack the sales components.
Okay, for fuel supply agreement sales, FSA sales. The quantity decreased by nearly 7 million tons,
Okay, less volume sold under FSAs.
which impacted revenue negatively by over 1,000 crore. However, the average price per ton actually increased slightly by about 25.
Ah, a small positive on the price side for FSAs.
Yeah, which cushioned that blow by adding back over 400 crore. But the real challenge, it seems, came from e-auction and washed coal sales.
Right, the more market-linked segments.
Exactly. E-auctions suffered a double hit. Lower quantities and sharp price drops.
Ouch. How much did that cost them?
That cost CL over 600 crore in revenue, combined. And washed coal, despite a slight increase in quantity sold,
Okay.
its price plummeted, down nearly 1,000 rupees per ton.
Wow, that's a massive price drop for washed coal.
Yeah, which sharply eroded those potential quantity gains, costing them over 300 crore. So in the end, despite all these shifts,
All these moving parts.
the overall average realization per ton remained nearly flat, just up about euro.
Right. This breakdown clarifies a lot about the pricing dynamics they're grappling with, doesn't it?
It really does.
It's evident that the significant price drop in e-auction, and especially washed coal sales, those more market-driven segments, largely explains why overall revenue from sales was challenged.
Despite the FSA price bump.
Exactly. Those pricing pressures in the spot and specialized markets just outweighed that slight price improvement in their long-term FSA contracts. It really highlights the vulnerability to market price swings.
Makes sense. Now let's turn to the other side of the ledger. Expenses.
Okay, the cost side.
Where did costs shift, and how did that contribute to the profit squeeze we saw earlier?
Crucial question.
Well, interestingly, employee benefits expense was actually down 1%, a decrease of about 132 crore.
Down. Okay, that's a positive. Why?
The main driver here was a 5% reduction in salary and wages, saving over 400 crore,
How do they manage that?
partly due to a 3% reduction in manpower. Fewer employees on the payroll.
Natural attrition, perhaps?
Likely. However, this positive was partially offset by an increase in actuarial liability of 266 crore.
Ah, so higher provisions for future employee benefits, like pensions or healthcare.
Essentially, yes, an increase in their long-term obligations, so not all savings drop to the bottom line there.
Got it. What else on the cost front?
On the other hand, finance costs were up, a notable 27% increase,
27%. Why such a jump?
driven by increased interest on loans, particularly from their subsidiaries, BCCL and ECL,
Okay, borrowing costs.
and also something called the unwinding of discount related to mine closure plan revisions.
Right, that's some accounting adjustment. Basically, as future mine closure costs get closer, their present value increases, hitting the P&L now.
Exactly. Then depreciation and amortization also saw an increase, up 18%.
Another significant jump. Any specific reason?
A big one was a 167 crore provision for impairment of exploration and valuation assets.
Impairment, meaning they think those assets are worth less now.
Yes, apparently due to 17 coal blocks in their SECL subsidiary being declared a safety zone, plus an increase in site restoration amortization.
So asset write-downs and higher future cleanup cost recognition adds up.
It does. Now, a notable positive was stripping activity adjustment.
Okay.
That saw a reduction of 21%, which actually added back 362 crore to the profit.
Added back, how does that work?
It's attributed to improved access to coal, meaning they maybe didn't have to remove as much overburden relative to the coal extracted in this period compared to what was deferred previously. It's complex accounting.
Related to deferring overburden removal costs.
Right. And it's worth noting CIL continues to carry forward a huge stripping activity provision, nearly 58,000 crore on their books.
Wow, okay. Anything else under expenses?
Finally, other expenses were up 7%, an increase driven by a few things. Higher provisions for doubtful debt,
Customers potentially not paying?
higher security expenses, a new levy in Jharkhand, the JMBL cess hitting BCCL, and also higher CSR, corporate social responsibility expenses.
So a mix of operational and compliance-related cost increases there.
Yeah, offsetting some small decreases elsewhere like R&D.
Okay, so zooming out from all those details, the profit decline clearly isn't just about lower sales volume, is it?
Not at all.
It's a complex interplay. You've got the pricing pressures we discussed on the revenue side, combined with these rising operational costs on the other side. While they saw that positive shift in reduced employee expenses,
Which is good news.
it was largely counteracted by those increases in finance costs and significantly those one-off impairment provisions. This really highlights a critical challenge for CIL, effectively managing these diverse cost centers. Ensuring that these cost pressures don't consistently erode future profitability seems key.
Absolutely. Okay, but here's where it gets, I think, really interesting.
Oh, yeah.
CIL isn't just sitting still, focused only on coal, right? They're making moves.
Strategic shifts.
Exactly. What are some of their major strategic initiatives and new ventures that show they're thinking beyond their traditional business?
Diversification.
Big time. They're looking into critical minerals. They signed an MU, a Memorandum of Understanding, with Hindustan Copper Limited
Interesting. Copper.
to collaborate in copper and other critical mineral sectors. Plus, they've been busy with graphite and vanadium.
Really? How so?
Yeah. CIL was the preferred bidder for a mining lease for the Aurangabad graphite and vanadium block in Chhattisgarh.
So, actively moving into minerals needed for, say, batteries and new technologies.
Seems like it. And there is a significant push towards renewable energy, too.
Okay, what are they doing there?
Well, they signed an MOU back in May to set up a 500-megawatt solar power project in Uttar Pradesh.
500 megawatts is substantial.
And they even incorporated a whole new renewable energy subsidiary in June, CIL Rajasthan Akshay Urja Limited.
A dedicated company for renewables.
Yep, with CIL holding 74%. So, a serious move.
Definitely sounds like it. Are they still doing anything new on the coal side?
They are, actually. They're not entirely abandoning new coal operations. A new mine, Kotra Basantpur, began operations in April.
Okay.
It's under an MDO mode mine developer and operator with a capacity of 5 million tons per year, MTY.
Right, outsourcing the operation but keeping the resource. It's quite striking, isn't it? How Coal India, a company synonymous with coal, is actively diversifying into such a broad energy and mineral portfolio. Copper, graphite, vanadium, large-scale solar.
It is a significant pivot.
These moves are clearly a strategic response to the evolving energy landscape. It signals a long-term vision that stretches beyond just thermal coal.
Looking towards the future.
Exactly. This proactive diversification seems crucial for their future sustainability and relevance in a changing world. But, a key question is how these new ventures will actually impact their overall financials.
Right. When will we see returns from these?
In the coming quarters and years, it takes time and investment.
Good point. Now, for those keeping an eye on the stock, the investors listening, what's the latest on dividends?
Always important for PSU stocks.
CIL declared a first interim dividend for this fiscal year, 2025-26. It's 5 rupees 50 paise per equity share, 5.5.
Okay. Consistent with their payout history.
Seems broadly in line. The record date for shareholder eligibility is Wednesday, August 6, 2025.
Got it.
With payment expected by August 30th. Now, what about some key financial health indicators? Ratios.
Yeah, how's the balance sheet looking?
Their debt-equity ratio increased just slightly to 0.10 from 0.09. Still very low, really.
Very low leverage, typical for CIL.
The current ratio, a measure of liquidity, is at 1.56. That's up a bit from March, but down from a year ago. Still looks pretty healthy, though.
Okay, managing working capital, all right. What about profitability ratios?
That's where you see the impact of the profit drop. Return on average equity, ROE, and return on average capital employed, ROCE. They saw pronounced declines compared to previous periods.
Right, reflecting that 20% fall in PAT we talked about.
Exactly. The annualized ROE, for instance, looks like 8% for the quarter versus much higher figures previously. Same story for ROCE.
Okay, so looking at the larger arc here, while that consistent dividend payout offers some comfort, especially for income-focused investors, the slight increase in debt, even though it's low, and more importantly, those pronounced declines in profitability ratios like ROE and ROCE, they do raise a significant question for investors.
Which is?
Are the strategic diversification efforts they're undertaking, which we just discussed, are they robust enough or happening fast enough to offset these current pressures on their core coal business profitability?
A crucial question indeed.
The market will undoubtedly be scrutinizing these ratios very closely as CIL navigates this transition. It's a balancing act.
Definitely. Now, no deep dive is complete without addressing the hurdles, the challenges.
True. Every company faces them. What did the review highlight for CIL?
One major ongoing one is the inverted tax structure under GST.
Ah, yes, the input tax credit issue.
Exactly. They have a massive accumulated input tax credit, ITC. Over 17,500 crore as of June 30th.
17,000 crore. That's huge. Just remind us why that happens.
It's because the goods and services tax, GST, on their inputs, things like machinery, explosive services, is high, often 18 to 28%.
Yeah.
But the GST on their main output, coal, is only 5%.
So they pay more tax on inputs than they collect on outputs. And because coal is essential,
That excess credit isn't refundable. It's just available for utilization against future GST liabilities, which accumulate slowly given the low output tax rate. So it's essentially stuck.
a massive chunk of working capital locked up due to tax structure.
Precisely. Then there are compliance issues. The company's board of directors currently doesn't have the required number of independent directors.
As per SEBI regulations.
Yeah, the stock market regulator, and that's led to penalties from the stock exchanges, amounting to over 2.6 crores so far.
A governance flag.
And finally, there are pending levies. The financial effect of a Supreme Court decision regarding certain state government levies for land usage in mining. That's still pending determination. An uncertainty hanging over them.
So, tax issues, governance compliance, and legal uncertainties. Quite a mix. It's really remarkable, isn't it, how regulatory and tax complexities can have such a profound and long-standing impact on a company's balance sheet, even a giant like CIL.
It really is.
That accumulated ITC, over 17,000 crore. It isn't just some minor accounting quirk. It represents a substantial amount of locked-up capital that could potentially be used elsewhere. This clearly highlights the complex regulatory landscape CIL operates within. They're constantly balancing compliance, these legacy issues, with their ambitious operational and strategic demands. It's not easy.
Not at all. So why should you, listening to this, care about all these details, these numbers, these strategies, these challenges?
Yeah, what's the bigger picture?
Well, this isn't just about one company's balance sheet. It's about understanding the complex interplay of government policy, market dynamics, operational realities,
And strategic pivots.
that shape a nation's energy future. Coal India is right at the heart of that in India.
A real bellwether.
So to recap, we've explored Coal India's Q1 FY26. We saw the dip in profits and operational metrics,
Driven by both pricing and cost pressures.
but also their bold steps into new energy frontiers like minerals and renewables,
A clear diversification strategy taking shape.
and the underlying financial and regulatory complexities, like that huge ITC balance and compliance issues.
Right, and looking at that bigger picture, this deep dive really shows that Coal India's story isn't just about coal anymore, is it?
It feels like it's evolving fast.
It's become a fascinating microcosm of India's ongoing energy transition. They're balancing those huge traditional demands for coal, which still exist,
Powering the nation today.
with future aspirations in new energy, while grappling with these significant, persistent challenges along the way. It's a complex narrative.
It really is. So for you, the learner, perhaps the key takeaway here is that even in these massive established industries, companies are constantly evolving. They have to adapt, transform.
Change is the only constant, even for giants.
Exactly. So as we wrap up this deep dive, here's something to consider. Maybe mull over until our next session.
Okay.
How might Coal India's bold diversification into critical minerals, into renewable energy, how might that reshape its fundamental identity and maybe even impact the global energy landscape, say, in the next decade?
A big question. From national coal supplier to diversified energy and resource player?
Yeah. What does that transition look like, and what are the ripple effects? Definitely something to think about.